Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Sumeet, welcome to the Mint Equitymaster Investor Hour. Delighted to have you on this podcast.
Thank you.
We've been coordinating this for some time, and I'm sure the wait is going to be worth it. So one thing I want to kick this Investor Hour off. Generally, how we do the the Investor Hour, which is, could you talk to us and share with us a little bit about yourself? In your case, I'll also ask you to share about Malabar investments, but first about your personal life. Tell us where you grew up, which cities you lived in, and also a little bit about your family and whether there was any investment angle, while you were growing up, whether there were IPO firms lying around the house, and all that.
Sure. I'm happy to share. Hopefully, I'll keep it brief enough so that it doesn't bore any of the listeners. So I was born and brought up in MP. So I lived in a few places within MP. And the place I was born was close to Ratlam. And that itself has an interesting story. I might come back to it. But we lived when I was very young, close to Ratlam, grew up there, and then later on, went to Bhopal, which is where I did most of my schooling, and then came to Indore, for my high school, and then eventually came to Mumbai for undergrad. So this is sort of my growing up journey.
Yeah, and about your family a little bit, if you can, please.
Sure. So see that, I mentioned about this, place where I was born. It's a small village, actually, I think close to Ratlam. And it's interesting because we have no family connection to that place. I've actually never been there since I was 2 months old. And the reason for that is very unusual, right? It was because my grandmom, my mother's mom, or my nani, was working there. Now that itself is unusual because back in those days, people didn't work. Let alone sort of work in sort of remote places, and so the interesting part there, the reason I sort of bring this up is that on the one hand, I've had sort of a pretty smooth journey, right? I grew up in an environment where my parents, were very caring, very focused around education. My father was a professor. There was always this environment at home about learning things, about studying. I had 2 elder brothers who were good role models, and so I learned from them, try to catch up with them, and so it's sort of, through school it was very smooth sail. I was lucky enough to get into IIT, and post that have been able to, go to good organizations to work, good institutions to study further. So it's been a fairly smooth journey that way. But I think there is always, a foundation that allowed you for all of that to happen, and there's a lot of sort of sacrifice and effort and toil that has gone behind that, and that's where it's sort of important, right? So in my mom's and her mom's case, my nani's case, they were unfortunate that my nana passed away when my mom was 4, and my nani was only 21 years old. And they didn't have much of, family saving or wealth. So she had no choice but to work to support the family. And she worked at a pharmaceutical plant and then got trained as a nurse. And then for the next 2 or 3 decades, worked as a nurse and became the head nurse over time. And all of that hard work of traveling to different places, finding this job, having young kids, sort of growing them, educating them. If she had given up anywhere along that path, we would not be having this conversation today, right? So I think there's a lot of that effort and sacrifice that went in, and I see a similar thing on my dad's side. My dad grew up in a small village between Indore and Bhopal, and where everybody was sort of involved in agriculture, like his brothers were involved, and he at an early age sort of wanted to study, but there were no avenues to study, right? So since he was 10 years old, he left home, and there were no boarding schools back then, right? So he was like, first he was, sort of putting up with some relatives here and there, And at a fairly early age, I think he, found a close friend, and they became roommates. And so very early age, staying away, taking care of yourself, for food, studying. But he went on to study engineering and, became an engineer and then later on a professor. But again, like so much going out of the norm, right? To pursue something that he wanted. And then ultimately both my mom and dad coming together and sort of creating that environment at home, which allowed us to study and to get to these educational institution. That's what made it possible.
Yeah, that's the stories we share and the experience. It's so critical, right? Because when people are looking at their journeys, so much of it is just chance that happened way before you could have taken any deliberate decision in your life, right?
Yeah.
And any amount of importance you attribute to that is not enough, the way it's panned out. So your father was a professor, you say. uh, so he was, I guess, what was he teaching, if I may ask?
He was teaching mechanical engineering, and not that I don't think he ever asked me to sort of look at engineering. I don't think we ever had a conversation around that. But I do remember when I was between second or third grade, I was about 8 years old. That like most kids want to go with their dads to their workplace, and so I went with them. And at that time, he was running this metrology lab, right, which is this large lab filled with all these instruments that measure things very accurately and minutely. And I was just fascinated by looking at those, right? And I remember seeing this microscope and how you'd look at the speck of dust, which looks like a big rock, right? Yeah. Or even like looking at my little finger and saying, oh my God, it has like so many features that I never thought. And that just sort of curiosity, just sort of like, I said, this is amazing. And then we went and saw a workshop and, how they would take, a big piece of metal and could shape into something very beautiful or functional. And so, I think at a very early age, I sort of decided that, hey, I want to become an engineer. And it just sort of came, there was a natural curiosity. I was always breaking open these toys and seeing how they function and how they work. Yeah. And so it was just a natural curiosity that led in that direction. So I don't think I ever had any conversation with my parents about what I want to study. It was clear to me from very early age that this is what I wanted to pursue.
Nice. That's so nice to hear. When you were growing up, did you come across any discussions, or were you part of any discussions related to investments? Be it the stock market,
Zilch, right? So investing was there. I mean, it's like, I mean, that was investment, right? That you study and you learn. I think, like most middle class families, I think our parents, did focus a lot on savings and building assets, but it was always with a very conservative view. And that was the need of the hour, right? I mean, back then there were not too many other opportunities. So I think it was a very, investing was never a topic that came up. Even when I was, forget about at home, even when I went to college, and ITs had sort of fair bit of exposure, but even there, investing as a potential career option was not even in the top 10. Wow. It wasn't. I mean, forget about then. Even today, if you ask me what are my what would be my dream job, it would be number one, be a teacher, number two, be an engineer, and number three, be an entrepreneur, right? So, wow. So I'm an accidental investor. So it was not something that focused on. I think even I remember that when I was at IIT, there were, I think, two individuals that I know of who were actually involved in investing in the market. Only two of the 2000. I'm sure there were more, but two that I knew of, right? Okay. So it wasn't something that was pursued. Honestly, I think it was probably thought upon as not intellectually strong enough. And I think it probably still, I think most of my friends probably still think that, what am I doing? Like, this is so far beneath us, right?
They're doing the real stuff, building stuff, cracking big ideas.
Absolutely. Absolutely. Right. and so so I think, but a lot of the foundational stuff help you become a good investor. And I may come back to touch upon this later as well. But I think when I was at IIT, it's sort of it was really about getting a rounded education, right? I don't think I did that too much of studying, there, but it was a lot of education. Right? It was a lot about getting to know people. I mean, to give you a sense, in the first 17 years of my life, I didn't set foot outside the state of MP, right? So that's how insulated a life that I had until then. And so it was eye-opening to come to a place like Mumbai and get exposure to people from different backgrounds. It was just fascinating to learn from them and their experiences and sort of adjusting with them. And then later on, I got involved in organizing things. We used to have this festival called as Mood Indigo, and I sort of in my last year I ran that, and so it was a very interesting experience. It's almost like running an organization. The only thing is that you don't pay people, right? So how do you motivate people? How do you get them to work so hard for something whereas they're not getting paid? It doesn't help them. So I think those things are great experiences that you learn from. But at a more fundamental level, I think what IIT, or I would say any engineering education does is gets you into this mode of rational thinking, right? Is to just look at any particular situation and say, how does this happen? How do you analyze this? How can you make it better? And I think those fundamental ethos sort of stayed with you forever, and those are very useful in investing, right?
Yeah. Wasn't it Charlie Munger who said something about physics being very critical to every aspect of life, and everyone should learn physics?
Absolutely. I mean, Charlie talks about this whole interdisciplinary, sort of learning, and that's extremely important, right? Because there's so many important lessons from each of these disciplines that you can learn from, and you can, once you sort of learn them and you can understand the pattern recognition, you can apply them in many different cases, right? Yeah. So that was a foundation that was quite useful. Now, post IIT, back in our days, right?
Sorry. When you say days, when you say our days in IIT, you graduated which year? Just so that
I graduated in '93, so it's a while ago. So back then, essentially, your ticket to success and most accepted path was that you study well, you get good grades, you apply to colleges in the US, and you get a scholarship. You go and study there, and then you get a job, and you create a good life over there, right? So that was the deterministically sort of the best path of success that was there. There were not that many opportunities in India, unfortunately, back then, or they were just getting, sort of set up, post liberalization. But I was sort of clear that I didn't want to pursue that path. I liked working out. I wanted to be an engineer, and it was during my third year that I got exposure to oil and gas exploration, which is a very particular theme. But one of my seniors or mentors joined this firm called Schlumberger, which was a Franco-American firm, and it was one of those rare firms which used to come and recruit from India back in those days, and give you an opportunity to work sort of around the world. And so he invited me to come to Baroda, where he was training, and I went and saw, and I was just, again, I think, very fascinated to see the kind of work they did. And he introduced me to the gentleman who was running that operation. He was a Singaporean of Sri Lankan descent, and I sort of appealed to him that, hey, give me a chance to come and work with you for the summer. And he sort of kind of said, what will you do, right? Well, how can you be of use? But I sort of persisted, and this is where, if I go back to the qualities that I may have picked from my parents, I think my mom, through her experiences, just learned to be very persistent and and that fighting spirit to sort of remain, right? And so I just kept following up with them, and I think ultimately he gave up. He's like, okay, fine, you can come and work with me for the summer, and it was a transformative experience, right? I think I got exposure to real work. I think most, this was this practical training that we used to do between the third and fourth year, where most people would go and goof off somewhere. And I actually worked. I worked really hard, and I actually enjoyed it. I said, I like that, and so I went on to pursue that after I graduated, and I traveled. I had an opportunity to go work with another firm called as Baker Hughes, doing the same line of work in Europe. But before I could start there was a gap of 4 or 5 months, and I said, I can't be sitting for 4 or 5 months. And so I went and I took up a job as an automotive engineer at Kinetic Honda, and actually worked in the plant for a few months. It was only a few months, but I learned so much in those 4 months that I still lean upon till today, right? And so I did that, and then I went to Europe. I traveled and worked in a number of different countries, and this is where how education can make that change. So I was saying, for the first 17 years of my life, I never left the state of MP. In the next 17 years, probably in the next 10 years, I traveled 50 countries. I'd lived in 10 of them, and so just a great experience to go. You immerse yourself in different cultures, work with people, people speaking different languages, managing people much older than you. I think that was at an early age a very interesting experience. But above all, I think what that experience taught me was, when you're doing this type of work in remote locations, and back those days there were no cell phones that you can rely on, right? So any problem that happened, the buck stopped with you. You had to solve it. So whether it was troubleshooting a hardware problem, a software problem, a mechanical problem, a hydraulic problem, or people problem or client problem, you sort of manage that. And again, I think that sense of ownership and responsibility, I think this got inculcated and reinforced during that period. But interestingly, so this is the first time, this is like several years after I've graduated, that I first got exposure to investing. And this is because one of my mentors was an investor, and I started learning about investing from him, and I found it pretty interesting, right? That this is in some ways, I think I gravitated towards fundamental or value investing because it just was very rational, and that's something that appealed to me.
I'm not surprised. You're an engineer at heart. It has to be logical. There has to be numbers. It has to add up.
It has to add up, and as I learned that, I realized fairly early on that in order to be an investor, you have to understand businesses, and learning about businesses was actually very similar to learning about machines, right? There's a way in which they function. There's a way in which they fit in a broader ecosystem. No company is an island, right? It's dependent on suppliers and distributors and customers and so forth. So understanding how that ecosystem works, and figuring out what's crucial and what's a linchpin. I mean, these are some of the concepts that you would pick from mechanical engineering and transport them into the investing or business world. And so I found it pretty fascinating. I started to dabble on my own, followed sort of this Peter Lynch philosophy of investing in your circle of competence of things that you know. So I knew a lot, fair bit about oil industry. So I started to figure out like, what is the value chain, which are the best players, investing in them. And it was great education and learning and putting your money behind what you think. And it worked well for a while. But then I learned a very good lesson without having paid too much tuition fee for it, which is that, I think in the late 90s, you had this oil price decline. And even though I picked the best businesses in each one of those value chains, they all suffered because the oil industry as a whole suffered, right? So I think that's a valuable lesson for fundamental investors, that the macros do matter, right? You're not going to make your investment thesis based on the macro, but you can't, you can't ignore that, right? You can't get, sidetracked because of that. So I think that was a good learning fairly early on. But in general, I would say that phase was useful in two ways. One is in terms of establishing that this is something that I like and I want to pursue. And more importantly, number two, that I don't know enough about investing and I need to learn. And that realization led me to business school. And so I went to Wharton and I learned a lot about financial management, about investing, about running businesses, but even other things like accounting or marketing or pricing or operations. All of these are good building blocks in understanding businesses and as a result, for investing. So again, very, very useful experience. And I was sort of set to go and follow the investing path after that. But while I was there, I had an opportunity to interact with some of my classmates who had gone through consulting background. And I just loved the way they thought through businesses and problems and how these industries are evolving. Again, very rational thinking applied in a qualitative context. And I thought this is a training that I can definitely learn from. And I had an opportunity to join McKinsey and Company and focus on investing work with them. And so I took that up. Initially, I was focused more on technology and technology investing because that was my background. But over time, I looked at a broad range of businesses, both in US and Europe, but over time, a number of them in India. And as I did that, I think I learned a lot about understanding industries, how they evolve, the competitive landscapes, what makes businesses tick, understanding sort of the value drivers for these businesses, analyzing them rationally. And at some point, I was doing a fair bit of work in India. I was advising clients on making investments in India. And what I found was that when they asked about which sectors and which type of companies, some of the best ideas were these smaller mid-sized companies that were growing very well, that had good balance sheets, good cash flows, and yet they traded at a discount to where the larger companies were. And when we brought these ideas to the clients, they would agree that these are great ideas, but they would still not invest because these were too small to move the needle, right? And when I heard that from a number of different clients, it sort of reinforced the view that there is a fair bit of opportunity here, but not many people focusing on it, not because these are not good ideas, but because you can't deploy a lot of capital in there. And so this whole, going back to Warren Buffett's maxim of, go where the fish are, not where the fishermen are, right?
That's right.
And so I thought this is interesting. So let me get some feedback. So I went and talked to some of my mentors or value investors, some clients, and say, this is a thesis. This is what I'm seeing. Do you have any feedback on this or any advice? And two, would you like to invest in this, right? And it was in this process that I met Sash Spencer, who used to be a McKinsey partner back in the 70s, went on to run a successful private equity firm, and over time had sort of started to invest in managers. And he had great success investing in China through a firm called his Value Partners that he helped sort of invest in early on, which invested in small and mid-sized companies in sort of same way that I was thinking about it. And his view was that India, maybe 10 or 15 years behind, was ripe for it, but he couldn't find any manager who was doing that. So he said, "I'm ready to back you if you want to get started." And he was a great mentor in the early days. Unfortunately, he passed away sort of fairly early on in our journey. But it was quite helpful to have his vote of confidence, and then with that, we got sort of other investors earlier on, and we started the journey of Malabar.
Yeah. So before we talk a little bit about Malabar, because I'm not sure how many of our viewers and listeners would know exactly what Malabar does. So we'll talk a little bit about that. Just to step back, do you recollect what was your first investment which you made with your own money?
It was Dell Computer, actually. So that was it was because I had great experience buying this mid-90s, right? So
mid-90s.
Yeah. I had great experience in buying a computer. I was living in Europe back then, and you couldn't easily sort of get the laptops with the configuration that you want. and that was the only one where you could do it, and it was just so smooth. And so based on that experience, I bought that. Schlumberger was another easy one. It was a company that I knew well, and so these were some of the early investments that I did.
Recollect any Indian company that you took a fancy to those days, or it was
Infosys.
Infosys.
Yeah. And again, it was lucky enough that many of my classmates were, some had joined, some were analyzing these, companies early on in those days, and you could clearly see that they had the right culture in terms of building an organization beyond the individuals, and they were building a great reputation, and over time, especially as you got sort of closer to that Y2K panic that people were having, they stood, great chance to benefit from the journey that was taking place, right?
Yeah, that's so. The entire story you're telling us, a lot of pattern fits through, right? You're curious. You're always looking to learn. You're always looking for. I don't use the word value. You're looking for a logic that adds up, and then you're trying to see whether it fits your valuation parameter, because by then you've learned all your valuations, etc., etc. But I must say that we've had quite a few guests on the Investor Hour, and I think you are unique from the perspective that I can tell you at heart you're an engineer. When you're talking about engineering, your face is lighting up. I guess the same thing will happen when we talk about money, but people who are listening and watching, I think for the first 10 minutes, they would have probably thought I've got an engineer on the chat and I'm talking to him. But I think, I'm sure you think about it all the time. Do you think that not just doing the engineering, but having the passion for engineering and working, is it an advantage or a disadvantage when it comes to actual stock picking?
Yeah. So I'll come to that, and actually I forgot one step in between. I get this detours, which is once I decided to go do an MBA, it was this year time in between, and I thought that if this notion, I didn't understand that the term of this marginal return, but I understood that conceptually, that I can spend one more year and I'll probably learn something more, but this is sort of a risk-free year, if you will. That can you go and do something else, and actually changed track completely and went and worked for a software product company for a year. And just so much learning in that 1 year, right? Understanding of that business. And then the software that I was working on, it was applied in semiconductor business. And so I got a chance to learn a lot about semiconductor business at that. So again, I think in a way you would say that if I knew earlier on that I want to be an investor, there's probably a much shorter path to get there, right? But I had no idea. Till I think I was the age of 25, I had no interest in investing, right? So this wasn't the goal that I was working towards. So as a result, I've had this very circuitous path to get to the investing world. But in some ways, I'm better for it because having seen so many different businesses and how they function and what makes them tick, and even though they're quite different, there are certain similarities to their successes. It helps you become a better investor.
Yeah.
So not the path that I would recommend. If somebody wants to be an investor, I don't think they should be going and working in 10 different countries before picking up investing. But if you've done that, it sort of helps you in one way or the other.
It's built a foundation. I guess it's built a foundation for you to understand businesses more deeply. Very interesting. So the 2000 market crash, you were yet to go to Wharton, or you had gone to Wharton by then?
I was at Wharton, and so anyway, it was good time to be at business school. So it was sort of very interesting.
Life case studies in front of you, huh? All around.
Yeah. So for the first year of my business school, the value of options that I had left in the software company, they were just going up every day, right, to astronomical figures, right? And in my second year, they basically came back down, right? Mm-hmm. So I think that's also a good learning, right? That you got to follow the path that makes the most sense. And, particularly the markets and the valuations come and go, right? Don't let that sway the fundamental decisions that you want to make.
Yeah.
And in much the same way, I think, when we started Malabar, it was sort of 2007 when we decided, but back in those days, getting an FI license used to be a a year-long process, right? And by the time we got that ready, it was sort of well into 2008. Market already started to shake up, and just literally after we launched and we made our investments, you had the financial crisis, right? And India was untouchable. Small and mid cap were completely untouchable.
Right.
But so it would have been very easy to just say that, what, it was a mistake. Let's fold up, follow some. But the thing is that ultimately we believed in that thesis, that this sort of makes sense, and I'll talk about that in a second. But once you sort of decided on that path, then you need to commit and you need to follow that through, right? And so that's what we ended up doing at Malabar as well.
Yeah. So Malabar. So you're lucky. Indian bureaucracy helped you out by getting your license to you a little late. But in the sense that when you set up Malabar, what did you have as a goal? You mentioned the fact that, yes, you had seen small companies being ignored by larger investors. You had seen there's value there. But that final step to set up a money management company, or however you position it, what was the driving force behind that?
Yeah. So I think there were two things. One was in terms of coming back to India, because I was still living in the US back then. And it wasn't an easy call. So I was looking at I was pretty clear that I wanted to pursue investing, right? So I'd already spent probably more time at McKinsey than I thought. Again, all good time spent, learned a lot. But ultimately, I think the notion that if I liked investing and that's what I want to pursue, I should just go be an investor instead of advising people on making investments. And luckily, I think just given the amount of exposure that I had to various investors and firms, I had many good options to pursue, right? To take up a job. And those were sort of very easy ones to take, right? Very, great firms, high pay, good life, so on and so forth. But there were two things that sort of, I thought about. So one, or three things actually. One was, just having spent enough time in India and seeing what was happening here, it was clear to me that that over the course of the next decade, 2 decades, things will improve quite considerably, right? And there'll be tremendous scope for value and wealth creation. And if you wanted to start off, this is a good place to be in, right? When you have that kind of tailwind. Secondly, it was, and as I was evaluating the different options, it was actually somebody that I mentored. It was a reverse advice, right? And it was that forget about everything else, forget about the risk, forget about the money. What would you be most excited about doing? What were you the most passionate about doing? And instead of taking up a job, I think starting something from scratch and building that, I think, kindle that entrepreneurial spirit, right? And I think when you think of that way, like no constraint, nothing else, just purely what would you be most passionate about and more driven about working, and then it just sort of makes a choice very clear. Yeah. And then lastly, I think it was something more on a personal level. My father had some health issues, and I thought that if you're halfway around the world, spending time just becomes that much more difficult, and just coming home and being at least close by would be important. And I'm glad on that front that I was here, because he unfortunately sort of passed away about a decade ago, but at least I had 5 years of much closer interaction with him because I'd moved back to India.
Okay. So you've set up Malabar, you've decided what you want to focus on. And I think there were a couple of phases in this journey. One is the taper tantrum, 2012-13, right?
Yeah.
The other is we had this 2018 slowdown. I think ILFS was probably 2018 or 2018. Yeah. And then we had the pandemic. Talk to us about, now you got your own shop, you're raising money to invest. Talk to us how you navigated these episodes, because I think a lot of public memory is just focused on 2 years. Small caps have done well, but small and mid caps have had a pretty volatile decade, I would say. More than a decade, probably 15 years.
Yeah.
So talk to us how you navigated that, and where were you? How did the news break? How did you react to it?
Yeah, so we've had sort of 4 or 5 of these cathartic experiences since we started, 15 years ago now, right? So we had obviously the first one, the financial crisis was, we invested all our capital and boom, right? For 6 months straight, the market comes down, right? So, so that was one. Then we had 2010-11, right? In the European crisis, I think that was another one. Taper tantrum. We had small ones in 2016 at the beginning of the year and end of the year with
China. There was a China related. Was it?
Well, 2016 was the demon at the end. At the beginning was China, and then 18 you had the LRFS crisis. Then you had the COVID, right? So this is a given. It should no longer be a surprise, right? That every few years there would be something, right? And if you detach yourself from the pain of things going down, as a long-term investor, I think the way I see this, that I individually or our team or our investors will be investing more capital over the course of next decade or 2 decades, right? So if you're a net investor of capital, you should actually be excited by these periodic declines that happen in the market, because they give you an opportunity to invest in good quality companies at reasonable valuations, right? So you need to sort of take that in your stride. You need to sort of think through it rationally. I think for a typical economic slowdown, there's usually a playbook of how you play that. But then, you have COVID, for which there was no playbook, but then you develop it on the fly. But ultimately, I think you owe it to yourself, and more importantly to your investors, to think rationally through those periods, right? This is not the time to just take knee-jerk reactions. You think rationally what makes most sense, you make the right choices, and then you back yourself with that, right? And if I were to just take a step back, I think that the original, the thesis for Malabar of why we do what we do, right? What the first one I touched upon, right? But I think it's very clear that over the course of next 2, 3, 4 decades, India is going to be the fastest growing large economy in the world. And usually when there's a fair bit of economic growth, and especially when it comes from lower levels, it provides ample opportunities for value creation and wealth creation, right? So that's sort of the first, driver. The second driver, behind that, and why we focus on small and mid-sized companies, is that over longer periods of time, the smaller companies have the ability to grow a lot faster compared to larger companies. It's just the law of numbers, right? I mean, it's like a 5-year-old kid grows in percentage terms faster than a 10-year-old kid who grows faster than a 15-year-old kid, right? Just law of nature, right? In percentage terms, that's what matters. And unless you had unlimited amount of capital, percentage growth is what you're looking at, right? Yeah. And so that's why the focus on the small and mid cap, and it's also because it happens to be a more inefficient part of the market, right? So where your work, your research can actually make a difference. And so that's the second part. And the third one is that, and this is recognizing that while it can grow faster than larger companies, the segment happens to be more volatile, right? But that volatility is in 2 parts. One is just the market volatility, and there's not much that you can do about that, right? It's just endemic to smaller companies, that they have low liquidity, small amount of buying or selling can move the price, right? But what is more important is the second type of volatility, which is the business volatility, right? Is that with economic cycles, most smaller companies tend to have more volatile performance, but that's something you can control. If you pick the right set of companies, they can actually have far less volatility from an economic perspective in terms of their revenues, their profits, their cash flows. And if you can manage that volatility well, you know that over the long term, the price will reflect that performance, while it may be volatile along the way. And so there, what is most important to you is to have capital that's with you for long term. And that's why we have gone way out of our way to ensure that we get very long-term committed capital from our investors. And in that process, if you have to give up certain fees, if you have to give up a large number of investors, because people don't like to commit capital for long term to invest in public markets. It limits your business opportunity, but that is the right approach to be investing in the segment.
Since you mentioned investment horizon, what is your typical when you're pitching to someone? What do you say? How many years or how many decades should one think of in their head when they're giving you money?
See, when we are underwriting the investments, and that's why it has to align, right? So when we're underwriting investments, we're underwriting them with a minimum 5-year perspective. Right? That's the investment horizon that we look at. And that's what, when we go to our investors, we ask them to give us the money with committed capital for five years. Our average holding periods are probably closer to 6 or 7 years. And there are companies that we can hold for fairly long. I'm pretty sure that before I hang up my boots, we'll have companies that we've been in the portfolio for 2 decades, right? So it's not that that's the goal, but it's you've got to think at least in that time period, because that's what it takes for the business thesis to play out and for the markets to respond to that thesis. In some cases, maybe front loaded, but on average, that's what it takes, right? And so that's our investment horizon, and that's why we tell our investors that if you feel that you may have the need for that money before that, you probably shouldn't be investing into small mid cap, or you probably shouldn't be investing into equities, period.
Yeah, that's right. Yeah, that makes sense. About the pandemic, can you tell us how was May 2020 for you? How March 2020 for you? How was it? It started off with a little bit of volatility. I think the news had almost filtered in completely, and then you had this big sell-off, and then I think it was the Fed announced the first cut in rates or injection of liquidity, and then in April what had to happen happened. How were you seeing that pass through in front of you, and what were you deciding to do?
Yeah, so as I said, I think in the past when we have seen these economic cycles, we've had a very clear playbook, right? So as the markets sort of go up when the valuations are high, typically we would start to become more defensive. You would see the cash level in the portfolio sort of go up. So when things decline, you sort of wait some period out, and then you start to deploy capital. And not that you can call the top or bottom, but generally the period of most optimism is when you want to be on the back foot, you want to have more cash, and when the period of most pessimism, you want to be fully deployed, right? So I think that playbook sort of generally works out. But in case of the pandemic, there was no playbook, right? And first of all, in the small and mid cap, it already came after almost 2 years of declines, right? So the valuations weren't very demanding to begin with, and so that's why generally the allocation levels were on the higher side, right? Because that's what that environment would warrant. And then you had this sort of sudden drop where everything sold off, right? And luckily, I have colleagues who are, again, equally, if not more rational. And in those conversations, you'd probably not hear any panic. It was really just sort of analyzing the situation, right? And I think we were honest and humble enough to say that this is an unknown, right? You don't know how to deal with this, right? Having said that, what we were doing in that period was talking to all of our portfolio companies. One is to just ask for their well-being, and also sort of how they were preparing for the situation, right? We're lucky that we had investors or other partners globally, some in China, so we could bring some of those learnings and share those with companies in India in terms of how you can manage, let's say, factory operations in the face of COVID and so forth. But in that process, I think as we analyzed, we said we don't know what the impact is going to be, but we can tell for sure that there is a set of companies which is going to be least impacted, and there's a set of companies that's going to be most impacted, right? So we actually went and divided all the companies in our portfolio, as well as some of the prospective companies that were on our radar, in these 3 broad buckets, right? The bucket 1, a set of companies which would have minimal impact. Bucket 2 is one where you may have some impact, but it'll be short-lived. And bucket 3, where you would have either a deep impact or long-lasting impact. And so the very easy call for us was, number one, whatever extra cash that we had, we deployed in bucket 1. Second thing we did was took out some things from bucket 3 and allocate that into bucket one. And even in each one of these, I think interesting, we had sub buckets, right? So each one of these, we had like 1A, 1B, 1C, and so on and so forth. So you had these 9 sub buckets. And interesting enough, what you found that in the beginning, the early phase, the March or April, if you plotted the level of decline from pre-COVID, and pre-COVID for a date, we picked Valentine's Day in 2020, right? 14 Feb, no impact. So from that day, if you saw in end of March or beginning of April, for each one of these companies, if you say, what is the percentage decline? And you plotted that along the sub buckets, it was a very narrow band. Everything was down by 30 or 40%. And we said, this is irrational. The fact that the market is down is not irrational, but the fact that these are all down by the same is irrational. And that's why this sort of movement of capital from what would be most impacted to what should be least impacted.
Yeah.
Right. And as time went past, you start to see, this, what was a flat line, start to pick up the gradient the way you would like. And then it started to move up, right? So eventually, 1 or 2 quarters out, we found that some of the bucket 1 or 1A, 1B companies were already trading above pre-COVID levels.
Okay.
Right. And the bucket 3 companies were sort of down even further, right? So that's a rational way in which market should have behaved. But in the beginning, it was about creating liquidity and selling what you have.
Everything was sold out. And I think that's the time the rationality goes for a toss, right? Because the prices are being determined by the crowds and there's panic. And they're selling, they have to get cash. So they're selling whatever they can. But I like the way you put it, because you notice that in 1, 2, 3, everything had fallen 30, 40%. And that just doesn't make sense, because between them, they will be good and bad. And I think that's a great way to sort of think about it. Because typically what would have happened at that period is people are saying, is going to bounce back. So let me buy the stocks, whatever's available. But to think of it like this, where the decision to invest was not just like everything fell, the decision to invest was also not generic. It was based on your buckets and the way you moved money. And I'm not surprised. I'm sure you guys had a wonderful 2021, at least 2020, that financial year.
Yes, I think from a financial perspective, the fund did extremely well through those remaining 3 quarters of calendar 2020 and 2021. But obviously, it's in there. I mean, we need to be humble enough to recognize that it's in the backdrop of a lot of suffering and so forth. So, can't get too excited about that. But I would say that, in terms of the tasks that we have in terms of managing our investors' capital, I think we were able to discharge that duty reasonably well during that period.
Yeah. So if I just take that same example to 2022, when things are going berserk, and again, I guess everything is now going up. Those days, everything was going down. How did you deal with this kind of a melt-up which happened in 2022, early parts of 22, end of 21?
Yeah. So I think it's in end of 2021. I mean, we had seen this movie several times before, right? I mean, you had seen this in 2010, but 2012, 14, 17, right? So it happens periodically. And in those times, the approach that we take is that we look at each one of the businesses. We have a sense of what is the intrinsic value. When the price starts to go significantly above that, you start to trim that, because you know that your prospective returns, at least on risk-adjusted basis, are not as good, right? So you start to trim those, and generally that's how the cash level builds up in top of the cycle. The only thing that was a little bit different, this time around, this was the up cycle in 2021 was a little different compared to a typical up cycle, right? Which is, it was very uneven. So there were certain sectors or companies were still beaten down. So you could still have some opportunity to deploy the capital, which generally in a straight market bull run, you don't get that. And that's why you land up with a lot of cash, at top of the cycle. Not that you call it, but it's just the byproduct of seeing a lot of companies getting to a rational valuation and not being able to deploy that elsewhere because you don't find good opportunity.
Yeah.
So it was a little bit different that way, but I think by and large, we saw this happening, right? And the other thing that happened was was that many of these technology companies that we had known and tracked for some time, in some cases we had evaluated investing in them while they were private, and with one or two of them we had sort of held them in very high regard, and we would have liked to be investors, but the pace at which their valuation went up through the course of calendar year 2021 was just mind-boggling. And so eventually, even after doing a lot of work, we just sort of shrugged and said we have to walk away because it doesn't make sense to invest at these valuations. And our view was that these are good businesses. Some of them may go on to create a lot of value, but you will probably get a time to buy them at cheaper valuations or cheaper price at some point down the line. It just happened a lot sooner than what we would have expected.
So you followed your process through, and I guess worked. And that's am I right in saying that takes the emotion out of the decision just by following the process that you have? Because I think in 2021, it must have been a terribly difficult decision to exit, because all the news, that was the time when you had all those Reddit groups doing all the fancy stuff all over the world. Even in India, there was a lot of stocks that were going up, and I think only if you were very disciplined could you take the call that these valuations don't make sense and you have to exit. So I'm wondering how a typical individual investor would go about protecting themselves from such, fear or greed. And the best way to do that is probably to have a process which tells you that this is the kind of valuation that is bearable. And beyond that level, when it goes to extreme, no matter how much you like the stock, like you're giving the example of those tech companies, you have to say tata bye-bye and move on.
Yeah, so I think valuation is important, right? It's a very important factor in your decision-making process. And if you pay too high a price, your denominator is so big that to generate returns from that becomes that much more difficult. So it is quite important to look at the valuation, but valuation is also not an easy decision, right? You always try to make it formulaic and make it easy and say, here's the PE business you should buy at, or comparables and so forth. But it's a shorthand for a lot of very complex variables that go into it, right? So it's about the growth trajectory, the evolution of that, the capital intensity in the business or efficiency of it. The many things that go into it, right, to come up with what is the right valuation. But suffice to say that once whatever method you've used to come up with the right valuation or the intrinsic value for the business, you need to have the discipline to buy it at a discount. And when it goes far above that, I would say, if it exceeds that, you don't want to play the knee-jerk move of saying that, hey, I know the answer, because I've seen, we're humble enough to know that very often we call something expensive and it kept on moving up because the fundamentals were improving. Right?
Yeah.
And your growth trajectory just sort of going from this gradient to this gradient can make a huge difference to what the company is worth, right? So it's not an easy exercise, not a simple exercise, but just because it's not easy or not simple doesn't mean that you should be doing it.
Right? Yeah, the famous phrase, right? It's simple but not easy.
Yeah,
you have to really work hard at doing the simple stuff right, and you'll have all the success that you want, I guess. Let's talk about. Let's go a little deeper. You've touched upon what you look for in a stock a while back. So talk to us maybe in a little more detail, and if you can share an example from the past, some investment you made which is not time sensitive, on what is your decision making process for a stock, what kind of filters it has to pass, and that will flow into the discussion on how many stocks you like to hold at one point in time. So let's start with that. Yeah. Mm-hmm.
Sure. So broadly speaking, we look at three factors, or we call it sort of the three pillars of investing, for us, right? And they're simply put: quality of business, quality of management team, and the valuation that you pay for that combination, right? But these are sort of very generic, high-level terms, right? So let me drill down deeper into what we mean by that, right? So when we say quality of the business, what we're looking for is essentially companies that have the ability to grow significantly above the market growth rate, for an extended period of time, and to be able to fund that growth by and large through their own internal accruals, right? But this is a mouthful, right? It involves a lot of different things. For this to happen, what you need is a company or industry where there's a large enough TAM, or the total addressable market. The market is sort of growing over a period of time, which provides that runway for growth. But also, you need a company that has the ability to at least protect, if not grow, its market share over a period of time. You need the company to be able to have the inherent economics that generates the cash, which means that return on equity and or return on capital needs to be far above their cost of capital, and the capital intensity in the business, right? So whether it's fixed capital or working capital needs to be low enough, right? Then only this model works, right? That you generate enough cash from your existing operation, you use that to sort of keep growing your future business, and you can do it without sort of needing external capital. So in engineering terms, this is your perpetual motion machine, right?
That's right.
And so if you can find that, that's a great business to be in. But the businesses like that are not made every day. Right? They're few and far in between. And if you start drilling into it, just this notion that for a company to have return on equity or capital far above their cost of capital, the company cannot sustain that over long term. The competition would not let you have that if there are no barriers to entry, right?
Yeah.
So the company needs to have a fairly strong moat around their business, and some sort of competitive advantages that others cannot emulate, and only then can you sustain those economics over the long term, and can compound those revenues and earnings for your investors. So that's basically what you're looking for, and typically you find that when you have these companies, as absolute leaders in the niche in which they're operating, right? And so that's a very critical part to understand, that just because a company is small doesn't mean that it has great prospect, right? Usually it's actually the odds are stacked against you, right? Because the larger players have more muscle, they have more advantages. But if you find a small niche or a nascent industry or sunrise industry where you are the strongest player within that, then you have all the advantages of incumbent, along with having, you're nimble enough to take advantage and grow a lot faster, right? So that's what you need to find.
Yeah. And so when I'm sort of talking to guests on the investor hour, the point on return on capital comes very often, right? The company has to be generating a healthy return on capital. I don't really come across such a discussion when individuals are investing stocks. They are still at PE levels and, the more basic criteria that they're looking at. Is that something that you come across as well? Because professionals are definitely talking return on capital, I know that. But outside of that.
Yeah. So again, at the expense of sounding like a nerd, right? which again, I'll take that as a badge of honor. But the real value creation is only when the difference between your return on capital and your cost of capital, that's what really you're earning, right? And the growth allows you to be able to compound that by reinvesting that capital over a period of time. So if you're in a business that's earning 10, 12, 13% return on capital, which in India happens to be the cost of capital, you can grow 10 times. You will just not create any value. And let me elaborate why. Is because the amount of capital that you would need to fund that growth will take away all the benefit from existing shareholders, because you would either need to continuously raise equity, which means dilution for existing investors, or you will need to take on debt, which means that you'll end up paying a lot of interest costs and you'll make the business risky, right? So as an investor, you don't benefit from that, right? The only reason you benefit is when your return on capital is significantly above the cost of capital, and then you can generate enough cash to fund your own growth. You don't need to borrow any money. You don't need to dilute yourself. Or if you're really lucky, you can have some extra cash available even after all of that, right? So that's why this return on capital is very important. And even if you're an individual investors, you can't ignore that.
That's a very good point. I think it's insightful for all our listeners and viewers to take note of. So the first point was quality of business. Second was quality of management. This is my favorite topic. So first, please tell us, how do you assess quality of management? What is your is the most qualitative thing in all that the 3 points?
It's very qualitative. But again, I think it's a quote that is attributed to Einstein, right? Which is that not everything that can be counted counts, and not everything counts can be counted, right? So this is not something you can count, but it's an extremely important factor. But again, extremely important factor from the point of view of a long-term investor. Perhaps if you're a trader, it doesn't matter as much, right? But as a long-term investor, we found that the management just tends to have an outsized impact on the outcome of a business, and as a result, for your returns. And as we sort of analyzed management over a period of time, we've sort of broadly categorized management quality into 5 different factors. So these are: number one, operational excellence. So how good they are in terms of understanding their business and operations. How well do they understand how the industry is evolving, how the competitive landscape is evolving? How would they stay ahead of the competition across their 100, 200, 300 SKUs? Where is it that they're losing money? Which customer they're losing money on? What is the plan to improve that? How they keep improving the margin year after year after year? How can they absorb it? So these are sort of the nuts and bolts, sort of operational decision. And as you interact with the management, you have to evaluate, how good they are on this metric, because ultimately that's a very important factor in the company generating the revenues and profitability over a period of time. Right?
So we had one guest on the podcast. He's a fund manager, and he was when we were talking about management, he told us he has notes going back 20 years. So he can literally tell the company, in 2002, you told me you're going to be doing this, and now you're doing something else, or So, as a thumb rule, if you don't want to do a very elaborate exercise in trying to understand the management, you have to just measure what they say and what they actually do.
Absolutely.
If they're doing that, you should be fine.
Yeah.
And if you digress, you can catch it, very quickly.
And you can easily calibrate after a while in terms of, whether they underpromise or overpromise, and how, whether to take what they say on face value, or whether you apply a discount, or so all of that you can evaluate. But I think that operational capability is number one. Number two, we look at his capital allocation discipline, right? So, and it's a very distinct attribute compared to the operations. You can find people who are very good at managing operations, but actually not so good in terms of capital allocation, right? So, how good they've been over a period of time, have they allocated capital at the right points in cycle, what is the incremental return on incremental capital employed, so on and so forth, right? So that's a very important factor, and particularly for the kind of companies you're investing in, which are generating a lot of cash, managing that and allocating that is quite important. Number three, and this is the most qualitative of this entire qualitative gambit, right, which is integrity and governance. And it's not an easy thing to get your hands around, but as a long-term investor is extremely crucial to ensure that the companies and the management team have the right moral compass that ensure that they would not shortchange their minority investors over time. And it just takes a lot of effort. It just takes a lot of pounding the pavement, meeting people who have done business with these guys over a period of time, suppliers, distributors, customers, ex-employees, what have you, right? But if you do enough work, you can actually get a pretty good picture. It's almost like each one of these data points are not useful, but they're all dots, and if you connect them, you actually get a fairly decent picture. So that's and the governance, again, you try to understand how they make decisions. How involved are the board members? Do they actually have real conversation and boards or not? I mean, we're lucky enough that in many companies where invest when the company is private, or if we're making a primary investment, we do have a board representation or right to board. So we have seen different boards function, and you can tell how a good quality board function versus the one where it's just rubber stamping, right? So that's the fourth one is the depth of the management team, right? So of course, when you're investing, a lot of it is bet on the owner, the promoter, the person who's driving it. But that is never enough, right? It may be enough today, but if you're investing for this business to become 5 times or 10 times the size, that's always going to be the bottleneck, right? So looking at the next level of management, right? How good they are, how capable they are, how much responsibility is being given to them, how well they're compensated. Do they feel the ownership of what they do? Again, these are subtle points, but very important in long-term success of the company.
Do you recollect any absolutely crazy moment with a company on its board without naming the company? That's fine. Something we came across absolute
Yeah, I mean,
the hell is this?
yeah, we've had the cases where the promoter or the owners would give you a very rosy picture of what the business does, but when you go to the plant, you find there is so much finished good inventory that's lying out, and you ask, why is this the case, right? And why are the customers not picking up? And you find out that they've had the problem in terms there's a slowdown, customers are not picking up, whatever, right? So you find those disconnects, right? So a lot of what we have to do is not rocket science. It's about triangulating things, right? I mean, we've even had the cases, again, without naming names, right? You look at the business that the company does and revenues that they make, and you just back of the envelope calculation that if you're saying your revenue is this much, average price of product is this much, you need to make Y number of units. And you go to their factory and you can take a stopwatch and see how many units they make in a minute, and they have 8 lines, and there's no way in the world you can manufacture enough number of units to make that revenue, right?
Yeah.
And so you walk away, right, from situations like that. And this is the unfortunate part, that you still find companies like that, right? Thankfully, over the years, our process has become stringent enough that we can weed out many of these things earlier on, right? The real obvious issues, you sort of weed them in your process earlier on. But even then, this entire process of triangulation, right? Even just understanding if a company is saying that I'm stick with the manufacturing example because it's easy to understand, right? You can, even simple stuff, right? They say, I'm doing this much revenue, triangulating with competition and market share, does this make sense, right? Checking with suppliers that are they sourcing enough raw material to actually make this stuff, right? Checking with dealers, distributors, right? So it's a fair amount of work, and I don't want it to sound very overwhelming, particularly for individual investors, but because they may not have the bandwidth to do all this.
That's right.
But in many cases, you don't need to, right? Because you see the signs of that emerge in different ways. But as professional investors, we have this burden of managing other people's hard-earned money, and you have to take that very seriously and very carefully. And that's why people go.
Yeah, I remember this China thing. There were investigative reports. I think there's a documentary on that, on the Chinese companies which are listing abroad. So one of these guys actually put a camera outside the factory gate, and he showed how in X number of days, hardly any goods had left the factory, and yet the factory, and they're announcing such big returns and revenue numbers. And it turned out to be a fraud. It was, just there. People are buying the stock in the US thinking there's great stuff happening, but all they're doing is, just putting it by pen or wherever they're punching it in an Excel sheet. So
and to the contrary, like we also had cases where we said a company is saying that their exports are growing, and we're able to, it's a landlocked city, right? So it's easy enough to find out like who are the import-export guys and check with them, and they actually corroborated that these guys were sending 1 container a month. Now they're sending 3 and they're asking for more, right? So, again, this is the diligence you have to do, right?
Yeah.
But anyway, to finish this process, if we talk about 4 of these factors, the 5th one is passion. How passionate is the management team about their business? And with the really passionate promoters or entrepreneurs, you can actually feel this in your conversation. You may be having dinner with them, halfway in between, they'll get an idea, they'll like be excited about it, right? They'll pick up the phone, they'll call up somebody, right? So you want to feel that, and you want to see that. And even with 2 companies, same industry, same quality, everything else, that extra bit of passion can actually add another percentage or 2 points of growth on top. It may not feel much, but 20% versus 22% compounded over 5 years makes a huge difference.
That's right.
And And I think, there's old saying that, your fist is stronger than each one of your fingers. It's the same thing here, that you need all of these 5 factors together.
Great.
Individually, it's an and function, right? You need to have all of these things together. It doesn't mean that each one of these need to be at the scale of 10, right? But they need to be good enough. And also, in some cases with younger companies, you may not find them, some of the metric lists, the second level of management team in a small cap, sometimes is not as strong. But what you would want to see is the trend of that strengthening over a period of time, right? And that improvement in these fundamentals, whether it's economic fundamentals on the business side or the qualitative fundamentals on the management side over time, that improvement actually ends up creating value over time.
Yeah. So you said you look at quality of business, quality of management, and valuations. So valuations, I think,
is the easiest of the 3, and that's why it comes to the last, right?
Yeah.
And it also happens to be a lot more fickle compared to the first 2. Right, the quality of business, quality of management team are very enduring. They don't change that easily. Yeah. The quality, the valuation can change very easily, and that's why we look at it the last. And if you like the first 2 and you don't like the valuation, we'll still keep tracking it, because that 6 months down the road, a year down the road, you may get an opportunity, right? Yeah. So, but it's an important part of the puzzle. I think we already talked about that earlier on.
So, in the context of trying to find the right stocks, you're looking for, you articulated superbly well on how you look for the business, what are you evaluating the management and the valuations. Can you share? So I have 2 questions. One came from my colleague, which I have to ask you. He mentioned Avanti seeds, Avanti feeds, feeds, Avanti feeds. I'm sorry, I'm not familiar with all the small cap, mid caps names.
That's okay.
So Avanti feeds. So the question I got was, we should ask you. It appears you exited the stock right at the peak. Now, this was those filters working through for you, which you mentioned, that you may like the company, but the stocks really rallied up, or did you come across new information and made you change your mind? Using that as an example to understand how this works.
Yeah. So it's a good illustration of a couple of different points, right? One is at the point of entry, right? So when we invested, this business was exhibiting characteristics that you don't generally see, right? It was a business that had 50% ROE and was growing at 50% year on year.
Whoa.
Right?
Okay.
And it was available at 10 times P.
Ignored segment of the market. Your hunting ground.
It's ignored. No brokerage house in this country has any analyst looking at aquaculture or a feed business of any kind, right? So it was just something that fell through the crack. Number 1. Number 2 is that because it was a sunrise industry, it was something that didn't exist before, it had just come up. There was a worry in terms of how does this function? Is it a flash in the pan? There were also certain worries about not for the feed business, which all Avanti did, but in the broader aquaculture business. Thailand, which was a big player, had a disease issue, and that led to big value destruction there. And so, we ended up researching it like any other company. I mean, me and my colleagues, I think we went to probably more number of shrimp farms than we would care to admit. We spoke to a lot of these guys, tried to understand why they use X versus Y. And we established that for a host of reasons that I wouldn't, get into, but Avanti did have a far superior product, and that's why they bought it. So we established that. Number 2, we even went to the extent of talking to people in Thailand to understand what led to the disease issues there. And you analyze that, you found out that, again, for a number of very logical reasons, you could not have that replicated in India, right? And definitely not to the kind of scale, because you have, the factors that led to that problem in Thailand don't actually exist in India, right? And so the risk we sort of understood and evaluate and eliminated, and the fundamentals were quite strong, so we sort of added to it. And then there's also the notion that in a particular year, if things are bad, and they were growing at such a rapid pace that a bad year means slightly slower growth and slightly lower margin, right? Mm-hmm. But and so the price was sort of beaten out. So we're already investors for some time. We'd already done quite well, but it was in the beginning of 16 or that time we were, as we did the field work, what we heard was that the price of shrimp was rising, and more farmers were looking to add to shrimp farms, and they were investing behind that. And usually that's a good leading indicator for the feeds business to grow. And so the stock was available, back to similar valuations where we invested, obviously higher price, but similar valuation. So we added a lot more. But then through 2017, you had 2 or 3 things happen, right? One is that the thesis that we had in terms of the growth coming through did play out, right? So the company ended up having sort of 50% plus year-on-year growth, which was stupendous, and and so that was quite well. But the second thing that happened, which, to be very honest, we hadn't anticipated or factored in, which was that the commodity prices actually came down. Soybean prices, which is sort of goes into the feed, the prices came down. So as a result, the margins expand, right? And so you had a scenario where the profits went up by 50%. The revenues went up by 50%. Profit went up by 2.5, something like that. But the stock went up 5 times, right? So on very high revenue, I wouldn't call it peak revenue, but on very high revenue, and definitely peak margins, people are willing to give it peak multiples for that business, and that combination is not a good one. And so that's why we, even though we like the company, let's see how they've managed it, we thought this was the right time to exit.
Oh, okay.
Again, I don't want to go into individual stock because I think you want to talk more about investing principles, but this is more of an illustration of how you rationally think through.
That's right.
On either side of that investment decision.
Yeah. So I think by using a case study, literally, I think it sinks in better because a lot of the viewers may be already aware of that company and the history, etc. So in that same context, if you will, can you give us an example of one failure that really stands out for you in a stock, in the process that resulted in that stock? And what was the learning you had from that? How did it change your process after that failure?
Yeah, sure. So, in investing business, it's impossible not to have mistakes, right? I think what you want to do, and again, I want to talk about it because the framework is important, right? Is that over time, you want to learn from your mistake and you want to minimize them, right? Or at least not make those type of mistakes again, right? So that's one. But in general, if you can reduce the number of mistakes that you make over time, it will sort of help you. And usually the mistakes that you make are because you let your greed or excitement overshadow the risk evaluation for that business. Right? By and large, that's the, if you think about investing mistake, that's what tends to happen. So anyway, so the number one is in terms of, reducing the number of mistakes that you make and eliminating these sources of mistakes. Number two is to have a process in place so that the amount of capital that gets allocated to the mistakes is actually low. And that's one thing where we believe that over the years, we've done a fairly good job, right? It's to devise a process where you may take an initiating position and you can make a mistake with that, but the position goes up in the portfolio only when you have a certain set of things that get established. And usually poor companies or mistakes don't end up qualifying for that. So you don't allocate more capital. And number three is obviously once you know it's a mistake, you all got to admit it, move on from that. So one of the mistake, and the more recent, we've had some in the past, but I think it's better to talk something that's more recent. Is a few years ago we had invested in a company called as Uniply, right? And there it was a change of management that had taken place. The company had been around for a while, but it was languishing. The new management came in, they put in sort of their own capital. They got sort of good other investors to come in. They also had team members come and invest in the company. And for the first few years, they've done sort of fairly good job in terms of growing the business, improving distribution, improving branding, and so forth, right? But ultimately, after that initial journey, I think this sort of the greed of showing better numbers or showing better price just led to them trying to expand into too many unrelated areas. And I think that was a warning sign for us, right? The first thing they sort of did was to expand and say, we're going to do real estate. And it was real estate because that's a way where you can absorb lot of the ply as well as some of the other building products, but that's a very tenuous connection, right? And that's sort of the pattern, and then we started to probe more. Then we saw sort of, some of the people in the management team leaving, and usually know that this is a bad combination. So while you had the right things in terms of management making a lot of positive changes, or people putting in their own money, not just the promoter, but also many of the management teams putting their own money, usually that's a pretty good sign, right? Yep. Skin in the game. But when you see a lot of moving parts like that, it's not a good sign, right? A frequent change of strategy and so forth. And so yeah, I mean, that was a bad mistake on our part to not have fully evaluated. I think at the point, I mean, we did a lot of work. It's not that we didn't do the work. We spoke to a lot of channel partners. We interacted with the management or other sort of management team. We went to their plants, so on and so forth, right? But ultimately, I think a lot of that value destruction happened because they started, if they had stayed in the ply business, right?
Yep.
It was a great, because, you had two very strong players. And then after that, there's a very wide space. So there was a clear opportunity to become a strong number 3 players. And had they kept their ambition focused on that, they would have created a lot of value for themselves and for the shareholders. But unfortunately, that didn't turn out to be that way, right?
Let's just say a lot of companies have ruined their future by venturing into new. Just because you have capital, you think you can do any business. And you're so right. Just because you sell ply doesn't necessarily make you a good construction, real estate.
Yeah.
Very extremely tenuous relationship over there.
Yeah. So again, I think in such the only challenge that we have, unfortunately, which thankfully individual investors don't have, is that if you're investing in small and mid-sized companies, and in many cases, liquidity is against you, right, as a large investor. And so even when you make a call, it really works both ways, right? Sometimes you find the greatest of idea, but liquidity is so low that, you can never build a position fast enough without impacting the price so that it moves the needle for you, right? And same thing on the exit side. But, that's a message for individual investors, that they don't have constraints like that. So in some ways, they have an advantage over investors like us. Right?
Mm-hmm. Yeah. So I'm just going to recap what you said, because I think it's so important, the takeaway from that. So you sold the stock for various reasons, but you could see signs. There's a forward integration being planned, and you're venturing into something which you may not really be very clear about. And you had management turnover, which again is a red flag that you have to investigate. And you still do all the other stuff, but these are, the typical points that come that sort of trigger the thought that maybe you need to relook and see if the investment thesis has changed. The other thing you mentioned, and I hope I got this right, you say so you have a very tight stock filtration process. You look at the business, the management, the valuation, etc. It's come into your portfolio, and I think you just said that you do an initial allocation, and as you get to know the business better, it becomes more core. Did I understand you right? Is that what you guys do? You're not jumping headlong because you've done everything. You're still taking it at a step in time.
So by and large, that's our approach, right? That we would take a small position and we'll keep adding to it over time. And that's a great thing about public markets, that allows you the ability to do that.
Yeah.
And even when we invested into private companies and which have gone public later, we follow the same approach, right? So not, just buy a small position in the beginning. As you get more comfort with the business, with the management, you sort of add more to it. And so that way, even if you make a wrong decision, it doesn't impact your portfolio as much, right? So it's a more, it's a more disciplined approach, and generally sort of keeps you in good stead. Every now and then, it does hamper you in good markets that you did all the work, you identify a good company, but you took a small position and then stock sort of really runs up, so you don't benefit fully. But you never lose money in that, right?
I was going to say that, because this is basically protecting your downside. Is that Buffett rule number 1: never lose money. So you're doing it very gradually, because you don't want to be in a terrible investment with a large allocation, right? And when you have skin in the game, you start going even deeper, I would assume. You're tracking it even more closely, and that can help you both ways. Yeah,
of course. And I want to make the distinction, right, which is that, again, the market price decline is a given in the segment that we're in, right?
Mm-hmm.
You can pick the greatest small cap company, and it's price, I would not be surprised if it goes down by 25%, in a quarter, right? It's, it can easily happen, right? So that's why it's extremely important to disassociate the market price movement from fundamental business. And so the way that we internally judge ourselves and evaluate is on the actual revenue and earnings performance of the company. And as long as that is there, we're okay to take market price volatility, because we know that over longer term, market price will reflect the intrinsic performance of the company.
Yeah. So effectively, you are making the most of the market inefficiency. You've come across a stock, you shared that example of 10 times earnings, market is ignoring it for whatever reason, the institutions can't buy, it's a fundamental reason. And if your valuation is what I guess is the gap between the market price and, you guys, and you can get to ride it without having to do anything really reckless, if you will, right?
Yeah.
So typically in your portfolio, or if you can think like an individual, how many stocks should there be in a portfolio?
Yeah. So it depends from individual to individual, right? So it's a different answer. I think as an individual, you can probably afford to be far more concentrated, because you don't have those sort of deployment or liquidity issues. You don't have as much diversification or volatility may not be as much of it. So you can afford to be more concentrated. And, as somebody would say, why would you not put your capital in your best idea instead of putting in your 10th best idea, right? So as an individual investor, you have a lot more leeway in that. As an institutional investor, we have certain constraints. I think we prefer the portfolio to be far more concentrated. And so for a small cap fund, our core portfolio, which is 15 positions, typically have bulk of the investment, so at least say 75-80% would be in those. And in the mid cap one, it's even more concentrated. So the top 10 position would have bulk of that portfolio. But the reason why it has to be that way is because with sort of bigger capital, you can't sort of get into position or get out of them very quickly. So you'll always have the tail position. Or sometimes you start buying something, the price moves up, you don't want to buy at that price, and that stub position sort of remains in the portfolio. So you have a little bit more diversification than what you would like. But at a fundamental level, we like concentration, and we like to have as much of it as we can.
And I guess concentration, it could be a direct result of the conviction you have in the stock. In that case, it's perfectly fine, right? You don't have to say, I'm going to own 30 stocks, 3.5%, 3.33% to diversify. And in a portfolio, you're bound to have even more conviction about some stocks than the others. And the technical point, maybe they can absorb more capital, not capital, their volume on the markets is such that they can probably take in more money as well. So it's a function of multiple things.
Yeah. And the last thing I would say that, we're not passive investors generally, right? So we engage with our companies quite deeply. And it depends. I mean, some companies are doing a great job by themselves, so we stay out of their way. But many other cases, we engage with the companies with the view that if you can help this company with value creation, you've actually played a constructive role with your capital, as opposed to just being a passenger in that journey. But you can do that only with that many portfolio companies. You can't engage with 50 companies like that.
Yeah. Okay, so we got a good sense of quite a few things, and very helpful in terms of how do you go about the selection process. Using that Avanti Feeds example, we have also got something in our minds from what you said is, how do you sell a stock, right? It may be a good company, but if the valuations go crazy, you have to sell. Or in case the management is not doing what it's supposed to do, generate the return on capital, or not diversify and blow up the money in an industry you don't understand, and therefore you don't want to take the risk. Anything else on the sell criteria that you want to add, which is absolutely important? Because one of the things that a lot of us have experienced when we meet people is people get wedded to stocks. A lot of the people take it from Buffett, where he buys a stock and holds it for life, right? But there are other very successful investors who can actually sell. You yourself have, if the valuation goes crazy, it's better to sell. So how do you reconcile these, and how do you suggest that people think through the sell decision?
Yeah. So I think good way to think through this is to always think about, at any point in time, you're re-underwriting your portfolio, right? So what is your prospective return from that position? going forward, despite all the run up that it has had. And generally, you would see that when company has gone up very quickly, it is most likely become more expensive, and it's also become higher weightage in your portfolio, right? So if you're freshly underwriting that portfolio, you'd probably not put it in that space, right? So your rational decision in that case is to pare it down, right? But you have to be careful with that, right? Because very often, see, market is quite smart. It's not, in general, things go up because fundamentally there's reason for it to happen that way. In some cases, it could just be a value unlocking or value recognition that happens. But in some cases, the sustained performance is because of an improvement in fundamentals, right? And so what you thought of as intrinsic value in the past, you have to relook at that. Right? And again, the notion about, as capital efficiency improves, as a growth trajectory improved, if any of those things have happened, you have to reevaluate it. But suffice to say that the rational view is that if your prospective returns from that point on is not as good, that's a reason for you to reduce or pare that position and sell. And I would say for vast majority of our sell decision fall in that category. That the good company, good businesses, that the business has done quite well, but the price and valuation have done even better. And it's from a risk reward basis no longer as attractive. And so it warrants at least paring it down. If exiting may be an extreme case, but at least paring it down and allocating that capital to places where you get better risk reward. Right. So that's by far the most important. But also there are other cases where, again, if you get the thesis wrong, as we're talking, if you make a wrong call on the business or the management, that's the reason to exit. Or this sort of evaluation within the portfolio to move towards higher concentration means that you get out of your, the lower conviction ideas and allocate that to better ideas in the portfolio.
Yeah, that makes sense. Just moving up a little on, we're talking stocks, small cap, mid cap, but how do you think of asset allocation? And I'm talking now all assets. When you're going about planning your wealth or thinking about how you should save for the future, how do you divide and how do you think about property, gold, stocks, cash, bonds? How does it work for you?
So I'll answer that quickly, but I will also caveat by saying that it works for me. Probably, each person has to look at their own situation, right? So, one of the things that I learned sort of early on in my life, again, I was going back to the parents and the values, is that it doesn't matter how much you earn, right? You got to manage your budget in a way that you save something, every month, every year. And if you do that well, you always have the ability to invest, right? So that's, first and foremost, something that I've followed. But then, once you have enough money set aside, cash for a rainy day or to take care of sort of needs that you have, and an ongoing basis, if you keep earning more than what you spend, that incremental saving, which you're investing for the long term, the best place for that is equities, right? And so, I would be far more indexed to equities compared to most individuals, because I think, again, if you have these things for you, right, that you have enough money set aside for any exigencies or for your needs, and ongoing basis, you're able to save, right? Then that money is best placed in equities. If you have 10, 15, 20 years of saving ahead of you, right? That's the best way that you would build that wealth. And so they're trying to diversify across too many assets actually becomes counterproductive, right? But as you grow sort of further in terms of your age, your evolution, or you want to make sure that you're still, keeping some money for needs that you may come, then yes, you have to keep some money in safer assets, right? So and those could be your things, typically things that people have in terms of real estate, gold, fixed income. But knowing that over the long term, all of those would underperform equity stocks.
Yeah.
Right. So again, the answer depends on individual. And the other thing I would say, and this is particularly true for some of the perhaps the younger listeners on your show, is that just start investing early. Don't think that I'm going to do this much later, right? I said, at any point in time, make sure that you save some amount of money, get into this habit of investing with discipline. If you don't have time to evaluate ideas, just put it in a set. It's a great way to sort of build wealth. And you'll be astounded with how much money you can compound over a period of 10, 20 years, even by saving as little as a few hundred rupees a month.
Yep. So I know we are running out of time. I'm going to still put a few questions to you, if that's okay.
Sure.
Yeah. So when you are thinking asset allocation, you of course you also have the added advantage of being in the space, and you get that. A lot of people who don't get that, like you rightly said, and it's great advice, you start the SIP. You'll still get exposure. A professional manager can, help you out with that. Uh, One of the challenges that when I meet people, is a lot of them are, let me get this right, income poor but asset rich. So, how does one reconcile that? Like, even if you start saving in stocks over time. So I guess it goes back to the sell criteria. If you have a need, you have to sell. But if you had to keep money aside, one of the things that a lot of people talk about is you need to keep 10, 12, 24 months of cash aside so that you are not forced to sell your stocks, because that's the biggest risk to actually doing well in stocks. Do you have any thoughts on that? On how do you sort of plan that in such a way?
Yeah, I think generally it makes sense, right? I mean, anybody you question that, I think last 2 years is a great example of that, right? When COVID something just came out of nowhere, right? I think most people at the beginning of 2020, the things or worries they would have had, COVID would not have ventured anywhere near that. But it can completely upend your life, right? So you can have these kind of things happen. So it is important to have a safety net, right? So it is important to have some cash set aside just for any of those needs, because the last thing you want to be in a situation is that when you have that need, you're actually forced to sell, some of your portfolio, because then you run the risk. It may be that, if that need were to arise in end of 2017 or end of 2021, great. But need doesn't arise like that. It can come at the worst point in time as well. And so at that point, you don't want to run that risk. So that's why it's quite prudent to keep some amount of money, not in cash, but in something which is relatively liquid investment. So if you need be, you can actually draw upon that, right? Or if you have, if you're privileged enough to be in a position where your earnings are far more than your expenses, so you know that you can sort of cover that. But otherwise, it's quite prudent to save money to last you for at least a year or something like that.
Yeah. Well, your thoughts on gold? What do you think of gold as an investment or a safety net?
So I'm not a big believer in gold, but I'm also recognize that it's been a store of value for over a long period of time. But again, I always think of assets as things that actually generate cash flows and are helpful. But I see the role it plays, and I think in India particularly, I think given the inflationary environment that we've had, it's been actually a decent investment over the long term, right, for people. So I see that, and then it also has the added advantage of being able to use as a jewelry, right? So there's benefit, right? So you derive some of the value out of that, but I wouldn't be caught dead wearing a single piece of gold. So.
Okay. You've invested in some of these new age tech stocks, right? I was told. Now, in a new age tech stock, if you do a typical intrinsic value analysis, it's going to be pretty challenging, right? So can you talk to us a little bit on how it's worked out for you investing in these new age tech stocks, and what are the learnings from there, which, as some companies come to IPO, the viewers and the listeners can sort of apply that and make a decision on whether they should be investing in those companies or not.
Sure. So by and large, let me take a step back. We've looked at technology because we think that's a very integral part of the way people live their lives today, right? And anything that plays a very important integral role in lives deserves a look. It doesn't mean automatically that you will have the right business model and you can earn it out, but it actually warrants a look. And so that's the reason to sort of look at technology, because again, I think over the course of next decade or two, you'll find that your reliance on technology will keep increasing. And as a result, there'll be a lot of value of wealth creation. And it's not a something revolutionary in the thinking. It has already taken place in other parts of the world, right? So I think the key then comes down to, do you have the right business, the right business model, and the right people, behind that? So the way that we've thought about is that we don't need to change our underwriting for looking at technology businesses, right? So we look at them at the same angle, right? Does a business have the ability to generate enough cash at high enough returns on equity and capital, and can that keep growing over a period of time? And so again, just from an illustration perspective, the companies that we have invested on technology side, whether public or private, right? So say a company like Apple or IndiaMart or Truecaller or Gupshup, these are the companies that, yes, they are technology companies, but they're all profitable, cash flow generating businesses, right? So that's what we look for. I think we don't have, we're not in the business of investing in companies that will keep losing cash for a period of time and that dependent on the largest of other investor or capital markets to fund them. And I think if you look at from that lens, you limit your opportunity set quite considerably, but it's a safer way to invest in technology.
So all you did was apply a proven framework to these new kinds of stocks, and you found the ones that still fit your criteria. So you're riding the growth in the tech, but in a more rational way, because there's actually a cash flow.
The only difference I would say, and this is also a big effort, is that the growth and the economics at which that growth comes makes their valuation on trailing basis still look expensive, but at least they have earning and cash flow based valuation, right?
Yeah.
Which many other tech companies don't have. So it does look like that. And we've had one of our earliest investment in India was in InfoEdge back in 2008. Right?
Many congratulations for that.
So again, it was the same. It was a highly profitable cash flow generating business that was beaten down during the pandemic and was available for quite cheap, right? So again, I think businesses like that have deserve for you to look at. They may look sometime a bit expensive if you're looking on the basis of trailing earnings, but again, if you do a very rational, logical analysis, you will find that you're still able to buy them below intrinsic value, right? And in cases, again, just from illustration point of view, and Apple or IndiaMart, when we bought them in 2018, they've been fantastic investment over the years because, again, highly profitable, cash flow generating, and that cash flow is increasing at a rapid pace over a period of time. That's a real value creation.
Yeah. So I really like this approach. You don't have to change your methodology. Don't give up on your proven methodology to invest in new kinds of companies. Apply the same thing. If they are really that good and they've got, they're generating profits and they're going to grow fast, it'll still show up. You can still do your intrinsic value analysis. So that's a great point. Thanks for sharing that. Really big picture.
Mm-hmm.
Tell us you came back to India. You obviously, love the country. What I'm trying to get an answer from you is on why the prospects in India today they're very good prospects. Everyone believes in it. But why is it different this time? Because in the past as well, India had all these great things going for itself, but somewhere along the way we, stuttered and, things went all right. Or do you have the conviction that India is actually in that 10, 20-year phase, which I guess all countries see at some point in time in their lifetime, which is going to be a tremendous growth phase. And therefore, if you play it well, you can actually have a nice ride for your own business or for your investments.
So I'll try to answer this quickly. I think there was two parts, right? One is that I somewhat disagree with this notion that things haven't worked out in the past. I would say that over the past 3 decades, since the economic liberalization, I think we've made tremendous strides, right? And the country has grown through, enormous amount of challenges that have come in place. And in that period, over the last 3 decades, you've had governments of left, right, center, everything else in between. You've had policy sort of changes, you've had nuclear tests, you've had crises, and everything has happened. And yet country has continued to chug along at a fairly decent economic pace, right? And the economic growth over those 3 decades would probably be just, below that of China, right? But it's been able to outperform pretty much everything else, right? So in some ways, I think that story has been played out.
Okay.
Probably slower than what people would want or expect, but that's just the nature of a messy democracy, right? That's just the way things unfortunately happen. And so in some ways, I think you can expect to see, same thing playing out in the future. that things will keep improving. Perhaps not as good a pace as you would expect, but hopefully a bit better. And there's some factors that are driving that, right? In terms of the way things have played out in the West, elsewhere. I mean, the way what's happening to population growth sort of around the world, or more importantly, the working age population, right? Is sort of declining in many parts of the world. And in India, at least, you have this potential benefit, right? That the working age population is increasing. So long as we're able to find good employment opportunity for them and a value creation that happens through that phase, that bodes very well for the country, right? And that's why this whole notion of China plus one, or looking at India as a strategic partner, all of those things are changing and are happening for India's benefit. But I would say that even before any of that, I think India's path or journey had continued to move along, right? And it's just the way that elephant moves, right? It just moves slowly, but surely and strongly, right? Overcoming all the obstacles.
Yeah, I guess it's a mismatch between expectations and reality. There's a lot that has happened, but we just believed, things would be super. You remember those days of double-digit GDP growth? 10%, 12%. I don't know whether those numbers are right or these numbers are right after they changed the methodology. But I think what you've told us is that the basic ingredient of growth, which is land, labor, capital, India is going to have a lot of labor, even as the rest of the world starts, witnessing declining or stagnating populations. So it's a very fundamental core answer. So you clearly believe that there's a 10, 20-year journey ahead, right? That's what you seem to be suggesting. And the way to position yourself to benefit from this, you can do a whole bunch of things, but in your view, is the small cap, mid cap space still as under researched as it was when you had those conversations and discussions in 2008? And is that still the space that you think will continue to deliver over time?
So I think there are definitely more people looking at the space, and that's a good thing, right? You want over time more efficiency to happen in the market, but I think what does remain the same is this notion of people's greed and fear. That doesn't change, right? That's just so intrinsic to sort of human nature that if nothing else, we would always have time arbitrage, because we're lucky enough to have long-term capital with us. The makeup internally of our team or organization is such that we're always long-term focused. We're willing to accept short-term pain for long-term gain. And as a result, we'll always have those opportunities. There will always be these points of panic where people are willing to throw away good quality companies at very attractive valuations. And that would happen far more in smaller companies, because even though more people are looking, the amount of research and the quality of research is not as good. And that's why the conviction may not be as good. And that's why they get thrown away. And given their liquidity, they go down even more. So you'll always have those opportunities, right? So I think, and then obviously Buffett even today says he's learning, right? So we are learning along the way as well, right? So you need to keep getting better at what you do. And I would say that, we have this internally, this view that we should look back at what we were 5 years ago and be able to shake your head and say, we were so naive back then, right? We're doing that so much better today.
Learning,
as long as you keep doing that, I think you'll always find opportunity.
Okay. My last set of questions. I'm going to rush this. I'm so sorry. I'm taking up too much of your time. So your wife comes to you and says, hey, I saved up 1 crore of rupees in the lockdowns. What should I do with that money? What would you advise her?
Well, it's two different parts. I would probably advise to invest, but I don't think that advice would be well taken. So, I think my wife, was born and brought up in the U.S., but she also sort of grew up in sort of middle class U.S. Environment. So while she loves to shop, but she always likes this, sort of value for money. Right? That's what she gets very excited by. So I don't think she would be spending 1 crore.
It's going to get invested.
But I think the place, and again, this tying into the earlier part, right? What really gets both of us very excited. I mean, you come to at some stage in life where monetary things can only add to so much of your pleasure, right? So the thing that that sort of excites us the most. And in her case, she sort of devoted her entire life to educating kids from underprivileged backgrounds.
Oh, wow.
And that's what she was doing in the US, and that's what she's been doing in India for the last 15, 16 years. And again, we've seen this in our case, right? I mean, education was the single biggest factor, right, in terms of changing the trajectory of my life and of many others like us, right? And so I think the biggest thing you can do is to provide the same opportunity to others who have the aptitude and desire, but they may not have the resources, right? And so, thankfully, because we are in this privileged position to do something about it. As boring as it may sound, we might end up spending a bulk of that money on trying to do something, and that's what gives the most pleasure, right? I mean, it's just amazing to see some of those kids, who, with the help of education, not just change their lives, but also of their families, right? Yeah. So it just takes a long time. It's not instant gratification.
It's cascading effect. It's a very positive cascading effect. Yeah. Wonderful. I'm so happy to hear that. Yeah, that's very inspiring. You have kids? 1, 2?
Yes, we have 2 kids, very young kids. So we sort of came onto this parenting journey a little late. Okay. So we have the joy of having 2 very young kids. So a lot of excitement. Wow. So, when I come home, they come running to me, and I know that it's not going to last very long. but I'm enjoying while it lasts.
Relish every moment. Relish every moment. So they're too young. So my question was going to be, how are you teaching them about money? So I don't know whether you had any conversations with them, because I think when they're born, so sometimes when you're born in an environment which is always sufficient, right? It's important to figure out a way to teach them how difficult it is to make money, or how easy is it to lose it, or to spend it away. So have you had any conversation, or still too early?
So I haven't had that conversation, but I think it's important, right? But thankfully, I think both me and my wife sort of came from that middle class background. You have those values deeply inculcated. Even today, the way we lead our lives is not materially different from that, right? So in a way, I hope that they will sort of absorb some of those values, and if not, we'll have the conversation. And also, I think this notion that you want to guide them in any particular direction, let them figure out what they want to do, and you want to, from monetary perspective, you want to give them enough that they can choose to do anything that they want, but not give so much that they can choose to do nothing.
Nothing, yeah. Those are golden words. Everyone needs to sort of absorb them and actually practice it. My final question. You're of course very well read. Give us some suggestions on what people should read. Any subject. What do you think makes a person more whole, right? In that, and also if you can talk a little bit about what global media you read, and which could help people, sort of broaden their perspective.
Got it. So I think on the investing side, I would say the book that has shaped my thinking the most is by Phil Fisher, The Common Stocks and Uncommon Profits. I think that's a great book, in terms of how to research companies, really understand the business, invest with a very long-term perspective. So anybody who wants to be a fundamental long-term investor, I think that's a great book for a person to read. For somebody who's investing as an individual investor, I think Peter Lynch's book are great. One of Wall Street, I think it's a great example of how how individuals can actually beat institutional investors. And for people who are interested in small caps, there's a book called A Zebra and a Lion Country. That's a very interesting book to read. So that's from an investment perspective. I really like history, right? So I think reading history books is very fascinating. And again, as I said, I was lucky enough early on to be in different parts of the world and to learn about that culture. But I would say even in India, I think I hadn't appreciated sort of post-independent history of India. And this India After Gandhi by Ramchandra Goel was
Yeah.
Great eye-opening book to learn about sort of what has taken place, and when you read those things, it helps you understand what's happening today in a very different light, right? So it's sort of quite helpful. In terms of global media, I mean, the thing that I've consistently read over long term is The Economist, and that's something that I enjoy. I think it's a good mix of, just being current around a lot of things that are happening around the world. It's an easy, quick read. So I still sort of out of habit keep following that.
Did you say it's a quick read? I try and read it every week. I've been reading it. It takes up all my time. It's probably, I don't know how many, 20, 30,000 words in the magazine if you're reading it cover to cover.
Yeah. So I think the trick there is to prioritize and pick things.
Yeah.
If you start with the cover to cover, that's going to take a lot of time.
Yeah, that's
also,
what
I mean, a lot of things online, right? So they have the online app, and they have news every day there, right? So, and many of those things go on to become articles in the magazine. So usually that's sort of one of the first things I end up doing. So
So I think it's very important for everyone to read global media. That perspective helps. And sometimes we are just a few years behind the rest of the world in several aspects, right? So that's like a low-hanging fruit that you can tap into in a country that's which is just a little behind, and that trend may play out here.
Absolutely, and having a balanced perspective, right? I mean, and then India has a very thriving media, and it's great, but at times it tends to become a little bit more triumphalistic, if you will, right? There's a lot of a nationalistic view in there, which is again great, right? For any country, it's important to have that spirit, but you need to have sort of balanced viewpoints, independent viewpoints, and it's helpful to read things.
I think you need to make you a good to make you better in everything you do. You need to be able to understand the opposite view as well as, if not better than the other guy himself, right? And those just make you a lot more sharp. It takes time. You have to invest time and read up everything and study everything and think over it.
So one easy way that I found is to actually confuse Google News, right? So I always end up also clicking on things where I just disagree with the topic completely. And over time, the algorithms get confused and they try to show you both. And it's good, right? It helps you get a balanced perspective, right?
That's a nice thing. That's wonderful. So goes back to your curiosity thing, right? You want to be learning and absorbing both sides of the coin and learning everything. So, Sumeet, it's been superb. Yeah, I'm sorry I took more time than we had planned, but
this is a very, very long hour. Yeah,
I'm just fascinated with what we've spoken. There's so much to take away. The stories you've narrated, your journey at Malabar, and of course the small and mid cap space and the filters that you spoke of. I think that is gold, pure gold. I hope people take notes when they see this and they try and implement some of this. So with that, Sumeet, thank you very much for taking time. And, hopefully we'll have you once again sometime next year, and we'll plan the time better. So it'll be the actual time and not expanded time.
No, this has been a pleasure talking to you. It's been a good long conversation. And other than illustrations, I think we didn't talk about stocks. It's really focusing on principles and sort of personal journey. So, very happy to share that.
Yeah, because I think this is going to make a longer term impact, right? Knowing what's going to happen in the markets 3 days from now or 3 months from now is not going to change your life. But if you can, I don't
even know the answer to that. Yeah.
There you go. But if you can learn from people, the frameworks, the structures that built around their lives, I think that is that is real stuff. And thank you for sharing all the real stuff with us.
Yeah, it's been a pleasure. Thanks.
Thank you.
Take care.